What is equity, and what does pizza have to do with it? I'm glad you asked, because I'm going to use pizza to explain what equity is. First, let's define equity. It's the resale value of your possession, be it a house, car, or even pizza, after you subtract all debts. Now, a demonstration. Let's say you buy a pizza for $5, but you buy it borrowing money from your mom. So how much equity do you have in that pizza? If you said $0, you're right. You can hold the pizza, you can dance with the pizza, you can eat the pizza, but it's worth nothing. Clear? No? Okay. Maybe this example will help you understand it better. Example 1. So again, let's say you borrow $5 from your mom to buy a pizza, but this time you have a business plan. You're going to sell each slice individually, and the pizza comes with 8 slices. So you sell each slice for $1. That means that pizza makes you $8. If you can realistically resell that pizza for $8, then it is worth $8, even if you haven't sold it yet. But your mom lent you that $5 on the condition that you give her 5 slices. So how many slices of that pizza is actually yours?
3 slices. And what are those 3 slices worth?
$3, because each slice is worth $1 when you sell it, even if you haven't sold it yet. Example 2. Now let's say your siblings start catching on, borrowing money from your mom to buy pizza and resell it to strangers. All of a sudden, your customers have a choice on where to get their pizza. Why buy it from you when your brother and sister are selling it for 85 cents a slice or 75 cents a slice? So now, in order to ensure that your slices sell, you gotta cut prices. You cut your prices from $1 a slice to 63 cents a slice. That means, in theory, if you were to sell all 8 slices, you'd get exactly $5 back. But you actually still owe your mom 5 slices, so you only have 3 slices to yourself. But that's okay, because as long as you sell all those 3 slices, you still end up with more money than you had before. But your mom, seeing you and your siblings making money, borrowing money, and selling pizza instead of eating it, no longer wants to be repaid in slices. Plus, eating all those carbs are making her a little bit heavy. Now she just wants her money back. So instead of demanding 5 slices, she's demanding her original $5 back. You get to keep all 8 slices to sell, but the only way you can sell it is by selling it for 63 cents a slice. That means you end up with a total $5 in your hand, but you gotta repay your mom that $5. So your equity is 0. Example 3. You're frustrated. You did all that work and you ended up with $0 in your hand. But you know that if you did not sell it for that price, you'd not sell anything. And you'd end up with $0 in your hand, and you'd still owe your mom $5, but from your savings. And so do your brother and sister, who also had to cut their prices in order to compete and finish selling their slices. Because unsold slices equals $0. Because of that, you talk it over with your brother and sister and you agree that no one can sell a slice for less than $1. You each end up with $3 profit because you got to repay your mom in cash now, and she lent you $5 each. But now, let's say the pizza place you buy the pizza from starts saying, if you buy this pizza, you cannot resell it. And on top of that, they also start selling pizzas by the slice and start telling people they can't guarantee the quality of the pizza if they don't buy it directly from the restaurant. All of a sudden, you're not only not allowed to sell pizza, but no one would buy it from you even if you could. Because let's face it, would you buy pizza from some rando selling it on a corner? So now you got 8 slices of pizza, but no one to sell it to. So not only is it not worth $8 anymore, it's not even worth the original $5 you paid for it. It's worth 0. And you still owe your mom $5. Since you can't pay her the $5 you owe, she takes the whole pizza from you, all 8 slices. Not only are you left with no money, you also have no pizza left. Your equity in that pizza is 0. $0. And 0 slices. Now let's apply this logic to a house. You buy a house for $100,000. It's a fixer-upper, but you're handy, and the bank requires you to put $15,000 down to buy it. What's a down payment? I explain what that is in my video, 4 ways to buy a house with no money down. So what's your equity in that house? As with the pizza, your equity depends on what you can sell your house for. Example 1. So we can ignore all the costs associated with selling a house. Let's say it's BlackRock wanting to buy your house and they're paying you an extra $50,000 in cash. So you sell that $100,000 house for $150,000. But you owe the bank $85,000 because you only put down $15,000 and borrowed the rest, $85,000. So you're left with $65,000. That's your equity in that scenario.
Actually, that's not true. In that scenario, that's your profit. Just because BlackRock paid you 50 grand above what you paid for it doesn't mean that's the market price of your house. Now, if BlackRock was buying all the homes in your area $50,000 above what you paid for it, then yes, your equity would be $65,000. Your market price would be higher, and therefore your equity would be higher. That's where the saying comes from, above market price. Equity is about potential. Profit is what you've actually realized. You can always realize more than your potential, but equity is about what you can realistically count on.
Example 2. Now, let's say you don't lose your job the next day. Instead, you lose it in 5 years because there's another recession. And because there's both, plenty of housing and no jobs because everyone's been laid off because of that recession, house prices crash. Supply and demand, because plenty of supply and not enough demand means low prices. And because of that crash, your house is now worth $85,000. Also, in those 5 years, you paid an extra $10,000 towards that loan amount, not including interest. So you owe $75,000 towards that original $85,000 loan.
That means you can sell your house for $85,000. You might get more, you might get less, but houses with your similar build are going for $85,000. So that's what you would probably get. And if you did,
you get to keep $10,000 in your hand after you pay off that $75,000 loan. That's your equity. But hang on, you paid a total of $25,000 to the bank. $15,000 down originally, plus $10,000 you paid over 5 years. Your equity in the property actually went down. You actually lost $15,000 in equity. So what is equity? It's what your ownership share is worth after you paid off all your debts. When you borrow money to buy something, the total sales price is first used to pay off what you owe, and then whatever is left is your equity. And life can affect the value or potential sales price of whatever it is you own. If something happens that makes your possessions worth more on the open market, your equity goes up. If nothing happens and your possessions stay the same price that you paid, your equity depends on what you owe the person who lent you the money to buy it. And if something happens that makes your possessions worth less on the open market, then your equity goes down.
I should also mention that equity is about the ownership share. Once you sell it, you no longer own it, and therefore it is no longer equity.
But does that mean the only way to cash in on your equity is by selling it? Well, not quite, but that's another video.